well. Now, real quick to kind of paint the picture of what's going on, as we all know, basically, as soon as COVID, of course, started, we basically saw about a month or 2 months of really kind of suppressed housing. That obviously led to an absolute boom with so many individuals. Actually, 32% of all individuals that have moved over the last 2 years relocated at 150 miles or more. What we've also then seen is we saw housing prices skyrocket. I mean, in most markets, they're from 2 years ago, you're up 30%. Some markets are up as high as 60%. We then saw the Fed basically have kind of sit on their hands too much. They put about 40% more money in the system without creating any more additional value, which has obviously led to this inflationary environment. And then in November of this last year, Fed basically went from saying that, hey, we think inflation is transitory, meaning it's just going to go away, to holy crap, we got a big problem on our hands. We're going to go away from basically just federal, free money, free flowing money, and we're going to start cracking down. And when this happened, we obviously saw the stock market take a nosedive. The NASDAQ's officially in a bear market. The S&P 500's flirting with the bear market, which a bear market is a 20% decline from the all-time high. We have always then seen mortgage interest rates shoot through the roof. Mortgage interest rates, at this time last year, we're sitting in the high 2s to around 3%. To where we're at today is the low to mid 5s on primary homes, obviously higher than that on investment properties. This, of course, has, even though we've had serious amounts of inventory shortages across the country, I've always said, those of you guys that have seen me come and speak in your office, I've told you guys many times before, I knew housing demand would be curbed once we started getting a 5% of interest rates. The psychological effect from a home buyer, as well as the pain that it feels in their actual pocket when we see that 5% clip. And what do you know? We saw that 5% clip get crossed roughly the very beginning of April. Basically, over the last, of course, 2 months, we have seen very, very, very many markets across the country really just kind of get their brakes kind of put on hold. And so one of the first housing reports I really want to show you guys today and walk you guys through is what we saw in the new home builder new sales report. So one of the hardest hit sectors over the last couple months has been new home construction. And the reason for this, very simply put, as you guys can imagine, the average delivery time of a home from somebody enters into a contract at a new construction builder till the time they take delivery of that home is about 7 months. So what ends up happening is somebody, of course, goes ahead, they get pre-approved to buy that home in October, November, when that home's being delivered in April and May. No longer, very few people do a 6 or 7 month rate lock because rates have been trailing for so long. They find themselves in a situation where, holy crap, my mortgage payment is about 40% higher than where it actually was previously. So as I'm going to go ahead and kind of share you guys my screen here for you guys, I'm going to go ahead and actually bring up a couple different examples here for you, just really quickly put. So the first one I want to show you guys right here on my screen for you guys here is this right here. Basically, if somebody was going to buy a home basically a year ago on a new construction home, get an $800,000 house, put 10% down, they got great credit, interest rates on a jumbo loan or high balance loan, they'd be looking at a total mortgage payment, principal, interest, taxes, insurance, HOA. As we well know, most new construction homes have much higher property taxes. Nationwide, it's about 1.6%. They'd be looking at a mortgage payment of about $4,600 a month. So that was their kind of, gauging, even as far as November, this is what their payment would have looked like. So, basically somebody wants to close on a home in November, $800,000 home, 10% down, they're about $4,600 a month. Well, what did we just recently see was we just went with the rise in interest rates we just saw. Check this out. So over the course of the last year, with the way house prices have obviously gone up, we have seen that $4,600 a month mortgage payment skyrocket to almost $6,300 per month. So you guys can very quickly and easily, do that math, or I can do it for you guys. But basically, at the end of the day, we saw, that house payment go up about 38%, 30 something percent in a very short period of time. This has led new construction to really, really slow down. And the first report that we just saw came out just this week. And this shows you what new home sales across the country are. Now, I'm going to hammer this home multiple times through this video, but the most important thing in this level you need to understand is Housing markets are going to behave like children, just like every single kid in a particular classroom has a completely different personality, completely different likes, completely different behavior. This is exactly what we're going to see. Housing markets kind of differ. We're going to see some housing markets over the next year continue to go up at a 15 to 20%. We're going to see other housing markets drop 20%. And where it really comes into play, and one of the big factors is the new construction delivery of homes. So here you guys can see the month over month change, one of the largest changes we've ever seen in history. New home sales, meaning the number of individuals that got a home under contract, dropped 17% from March to April. This was a dramatic decline. And what you guys can obviously see, just in December, we were seeing about 839,000 new homes being put under contract, 839,000 new homes. We've now seen that fall to $591,000 in April. Now, mind you, April is usually a very heavy buying season. This is where our buying season goes. This is typically, rather than it going down like this during this time of the year, this is normal. Going from, typically you'll be up here in the summertime, the wintertime will kind of slow down. First 2 months of the year, usually the slowest time. And then in March, it starts to kind of pick up. April, May, June, July, it really kind of goes off. And we've seen the exact opposite happen. We've seen new home sales drop by about 27% when you're comparing April of 2021 to April of 2022. And the factor why this has been hit hardest, much harder than existing sales, is due to these houses obviously having higher taxes, higher HOAs, and all of that. Now, one of the things you can see here is actually they're behaving very differently. So in the region, we actually saw the Northeast has a very small amount of new construction homes, and the Northeast is actually doing great. Their actual new home sales year over year actually increased, believe it or not, whereas the Midwest, the South, and the West all saw decreases, hit hardest in the South, believe it or not, and the West was down about 7%. So we saw a significant decrease in the amount of housing that was being done. Now, going into another factor I want to show you guys here. Let me pull this up for you. So here gives you a better picture of on the graph. Now, what's really important that just happened for almost the first time in history, you can see going back to April of 2017, what we're seeing here on the screen as I go ahead and blow this up for you guys is the orange line is the amount of new construction homes coming on the market. Okay, meaning new construction homes that are being either put up for sale or being done and being delivered by a builder. Okay, the blue line is the new home sales. Okay, and this is basically where we're trending for you guys. So as you can see, the sales for the last 5 years have always the new homes have exceeded the blue line, meaning the number of home sales. The orange line is the number of new homes constructed, have always exceeded, meaning we had more people that were getting homes onto the market than new home sales coming onto the market for that month, which has led to this inventory shortage. And we saw, obviously, I mean, you can see up in here, beginning right when COVID started happening, we saw this number be a great disparity. We had double the amount of individuals wanting to get or getting a new home sale under contract compared to the number of homes being delivered to the market, causing this massive shortfall. But look what just happened on a major basis. We had about 800,000 new homes be actually their construction being put on market and their construction being made available for sale on a construction date predetermined. So let's say I'm Lennar and I say, hey, I'm going to go ahead and, start construction on these houses and they're going to be ready for sale in 7 months. We saw 800,000 of those be basically kind of a coming soon or being potentially available for sale, while in that same month, we only had 591,000. So we have inventory rising on new construction and we have new home sale demand dropping dramatically. As you guys can see on this graph, by far the biggest we've seen over that 5-year period of time. And this is really important to note because new home sales really are the way we get inventory on the market, and that inventory number is picking up. Now, what I really want to kind of gauge this in and really go over here for you, okay, where are these construction homes coming to? Where are the biggest amount of single family? Now you have to understand they put apartments in here too, so it can be a little bit misconceiving, but here you guys can go. These are the markets that have the most new construction homes coming on the market. Now, what's important to remember is if your county is not here listed for sale, That means you don't have a lot of new construction in your market, which can be a very good thing, because when you don't have a lot of new construction in the market, you rely on existing sales and aging inventory. And with individuals staying in their homes longer, you got to think of it this way, guys. A year ago, or somebody could say, hey, you know what? I got a 3.5% rate on a house I bought 3 years ago. My mortgage payment's $2,500 a month. I can sell my house. I can get a bigger home. I can get a more expensive home. I can have a higher loan payment or higher loan amount that I'm borrowed, but the interest rate is 2.875%. So my monthly payment maybe go up $400 a month, but I'm getting 5-bedroom houses of a 3-bedroom house, or I'm doing the opposite. I'm selling my house in California. I'm moving out to Idaho for the same price of the house. I'm getting a house that's twice the size of it for the same price. My mortgage payment's actually staying the same, potentially even going down. However, what happens now is if I'm going to go ahead and sell my house here in California, let's say, and I'm going to go out and move to Boise, Idaho, and my house I have right here, I refinance and have a 2.875% interest rate. And now my house can sell for 800 grand. Now my house in Boise, because of how much the Boise market's gone up, is 700 grand. Let's say I put a big chunk down, but now instead of my 2.875 rate, I'm getting a 5.5% rate. That even though I'm buying a less expensive house, my mortgage payment is substantially more. And do I really want to make the move, uproot my kids, move my family from California and move to Idaho if I'm basically having a higher mortgage payment? Yeah, maybe getting a little bit bigger of a home, but I'm having a higher mortgage payment. So that's not very good. So the markets that we actually are seeing the most new construction coming on the market are markets in Florida. The Florida market is an outlier. It is absolutely booming. I'm going to show you guys later, and it's continuing to just really defy all odds as we continue to see a massive amount of migration moving into those areas. Some of the markets I'm worried about is Provo, Utah. Provo, Utah has seen a significant decrease in the amount of foot traffic. And I want to show you guys that right here. Let me pull this up. One sec. All right. Go. Okay. I'll pull it up in a second. Finish this one. So Provo, Utah is actually seeing about a 17% decline in foot traffic and new home sales, and they're continuing to be a leader in the new construction market. Austin, Texas, a 25% reduction in the amount of new home foot traffic coming through builders. Housing market in Austin, house prices in Austin is now as expensive as New York City. This is another market I'm really worried about. Provo, Utah, Austin, Texas. Another market I'm worried about is Boise, Idaho. Boise, Idaho has significantly overbuilt itself. And I'll show you here in a minute what inventory levels are doing. This is another market that's really, really weak. The Nashville market's still performing strong. You got Nashville moving there, Oracle moving there. You see a very, very, very low state income taxes there, very low property taxes there. So I'm not as worried about Nashville, Tennessee. Fayette, Arkansas is absolutely booming. This is where Walmart's based out of. I definitely agree with that. Ogden, Utah. It's another one. Saw 20% decline in the amount of foot traffic coming through new home sales, but they're continuing to be one of the leading builders. Phoenix, Arizona. It also saw about a 12% decrease in the amount of new home foot traffic going through. This is another market that I could potentially see softening, but not nearly to the levels. I think that the Phoenix market is going to be a market that slows down a little bit, but still going to see low single-digit appreciation over the next 12 months. The Houston market is booming. This is one of the strongest housing markets in the country, as individuals are willing to make that commute, basically working in the Austin and basically buying a house in Houston, Texas. So this is another market I'm really, really a big fan of. Now, I want to show you guys some of these inventory levels. I'm going to break it down by markets individually for you guys. But this shows as an overall nation. And you see when it comes to inventory levels, people are always talking about, oh, you know, new inventory, or inventory's 1 million. Okay, you have to understand that when you're looking at new inventory or housing inventory, you've got to pull out pending sales. A lot of providers of this, Zillow being one of them, actually goes ahead and actually lists the available inventory, which includes pending sales. We all know pending sales is not true inventory. So you got to strip out pending sales to get the true inventory number across the country. So year over year, which is the blue line, we've seen since the beginning of the year, inventory was down at the beginning of the year 30% from the previous year and 60% from the same time in 2020. This whole time period right here between like December in really March, I was screaming, we have such an inventory problem, such an inventory problem, such an inventory problem. And what we've seen since then is we've seen a lot more inventory beginning to come onto the market as people either want to capture the equity they have in their home by going ahead and saying, hey, things aren't that great with work with me right now. Let me take advantage. Let me try to sell when the market's high. Let me go ahead and put that up, as well as people just traditionally moving more in the springtime and the summertime where their kids are in school or getting out of school. So we've started to see it. So right now, for the first time, we are now at a higher inventory level nationwide, okay, and a lot higher in individual markets. I'm going to be going. We are officially at a higher inventory level nationwide than we were 1 year ago. That just happened in the month that just is passing ourselves in May right now. So just 2 weeks ago, we made that cross and it's continuing to go upward. But from 2 years ago, we are still significantly down. We're still down 50%. So please, guys, don't panic. Yes, we're trending up. We are still down 50% from where we were this time in 2020. So let's look. Let's see how the markets are doing in and of itself. Let's see what we're going to basically do is where is inventory surging the most across the country? Then I'll break it down and drop into the comments if you want me to pull up your particular market. So the market, now this is a trailing indicator because realtor.com basically just released their end of data during March. So that's why this is what were those numbers. We saw basically the 7 biggest markets out there as far as inventory surging, actually where we were compared to a year ago. Boise was up 62%, Provo up 40%, Vallejo, California about 33%, Michigan up about 30%, Salem, Oregon 30%, Ogden, Utah about 25%, Riverside County about 17%. And you guys can kind of see this list down here for you. Now, where we're seeing the biggest declines in inventory, Richmond, Virginia. This is a market that's going to remain very strong. They are significantly still down on inventory and they are not a construction leader in the market. So this market's going to still be a very strong market. Florida, well, you can see how many times you got a Florida in Northport, Florida, Naples, Florida, Port Lucie, Florida. But one thing about Naples, Florida has the highest amount of what I call shadow inventory in the country. What shadow inventory is those are homes that are not occupied. These are second homes. Another big leader in the marketplace is Lake Havasu. So what happens? You think about it with your guys' own financial situation. You got a renter in your investment properties. They're covering the mortgage payment. Rents are really high. You probably bought that property and the mortgage is very low. You're not going to likely sell your investment property as number one because it's cash flowing. It's actually helping you. Your primary home, you don't really want to have to sell that one because obviously you got to find a place to move and rents are through the roof. But second homes, your vacation home, your true vacation home, those are shadow inventory on the market, meaning they're vacant homes. And when things get tight, we can see these homes start to come onto the market. And if any market in the country, Naples, Florida, has almost 30% of all the homes that are in that county are second homes. Okay, not investment properties, second homes, true second homes. I'm not talking a bunch of Airbnbs. I'm talking second homes. This is a market we could start seeing some more inventory come onto the market. But we could definitely use it as we're super down. Again, another Florida market, another Virginia market, really down. San Jose, really, really down still. Santa Rosa, down still. South Carolina, North Carolina, Asheville, Shreveport, Louisiana, another Florida market, another South Carolina market, another Louisiana market. You got some, obviously, in Alaska. You got Georgia. You got another North Carolina market, South Carolina. So what you're seeing is the Southeast is still so below the inventory levels. This is going to be, in my opinion, the strongest, some of the strongest markets in the country are going to continue to be in that Florida market, going to continue to be in that Georgia market, Tennessee market, North Carolina market, South Carolina market, Alabama markets. You're going to see a lot of those as outliers, and you're also going to see the Northeast. Really, they are very, very low new construction being done. So your Chicago market, your Connecticut markets, your New Jersey markets, even your New York markets, your New Hampshire markets, your Maine markets, all of those are continuing to be great, really kind of standouts as we kind of continue into this recession. So let's look. So most people on this call, are from California. So let's just look at California. So coming here in California, this I have access to, allows me to pull any state in the country. So drop a question below if you want me to pull up your state, and I can go over the inventory levels, and I'll actually do that here in about 5 minutes. I won't wait till the actual end of the show. So let's go ahead and look at, I'll show you guys of all the United States first. So you can see now what it means. Blue means inventory is going up. Red means inventory is going down. So we can zoom in here, and as I was kind of saying before, one sec, pull this up, sec. So as we can see right here, here we go. You're going to see lots and lots of red up here in the Northeast markets and all this coastline, super short on inventory. So pretty much the East Coast Southern Seaboard, or the East Coast Seaboard, as well as the Northeast, significantly under inventory markets. I mean, you're seeing in Hartford, Connecticut, we're still down 60%. You're seeing obviously in some of these markets like South Carolina down 50%. You're also seeing the same place in the whole kind of Chicago markets, all of that market. So this whole area of the country is really, really short on inventory and is really going to continue to see some high appreciation levels in these homes. It wouldn't surprise me if we saw double-digit appreciation in most of these marketplaces here, especially down here in the Florida market, especially down here in a lot of the markets, Alabama, Arkansas. You're seeing a lot here in Tennessee. Now, it starts to change quite a bit differently as we go ahead and we kind of move and we go over to the West Coast. Look what starts happening when we get to the West Coast, guys. West Coast, we're seeing massive amounts of inventory. We're seeing Mojave, Lake Havasu City up 31%. We're seeing a lot of Maricopa County, Phoenix, it's not as up, but we finally starting to see a little bit more inventory come to the market, up 6%. San Bernardino County, one of the highest inventory gains in all of the country, up 31% in San Bernardino and Riverside County, California. Now, really, San Bernardino is actually having a lot more inventory than Riverside County. Riverside County is at 19%. I'm not as worried about Riverside County. I definitely think we're probably going to see between a drop in about 5% in prices to maybe 5% gain somewhere in that round, because we still are far more affordable than those areas. However, what we can see is you look here in San Diego. San Diego is one of the best performing markets. And look, once again, look what happens in coastal markets. Coastal markets are going to continue to do very well because you have very little new construction in coastal markets, as well as you're continuing to see demand for people that want to have the beautiful weather of the coast. They're a little bit more affluent marketplaces. They're not going to be as subjective to obviously what we're seeing in that inflationary market. So we're seeing in San Diego's still down 15% year over year, down more than 60% over the last 2 years. Orange County, even worse, 28% down in inventory from a year ago and almost 70% down from 2 years ago. LA market. Now up here in LA, once I go into the county, we see a lot of blue inland, but a lot of red, meaning a lot of shortfall in inventory in that LA market. Santa Barbara's way down. St. Louis is down. Santa Clara coastline is still down. Sonoma's still way down. You're seeing a lot of that. However, the inland markets, you're starting to see it a lot coming up. Look, 57%. You're seeing Sacramento County, 36%. A lot of those markets, you're seeing all these markets coming across here. This is where it starts to get interesting. You come up here into Idaho, you come up here into Utah, some of the biggest, you got some areas in Idaho, 133% increase. You start 80% increase in Oregon. You have another 95% increase in Oregon. Salt Lake City, Provo, 56%, 67%, 86% increase in Salt Lake City, Utah from that inventory from just 1 year ago. So lots of these areas are going to start seeing some softening in prices as we see a lot more inventory come onto the marketplace that's not being met with above average demand. So a lot of that we're going to continue to see in that marketplace. So let's dial down and let's really look at within here. Let's go within the county level. So we're going to go right in that county level, and I'm going to go right into Orange County, California, Riverside County, California. And I can drill down by zip codes. So what I'm going to be able to go ahead and do, sorry, here, let me pull this up. Sec for us. All right. Here we go. So I'm going to go into Riverside County, California. Pull this up real quick, and we can see what markets in within, because this is so important, guys. Data is everything. If you're a real estate agent and you're not so tracking and so paying attention to this data, it is so important for you guys to understand how you're going to advise your clients and tell them, where areas are really good to buy still if you guys don't know this information. So let's go into Riverside County, California, and let's see where we're at. So we can see in these marketplaces, we can still see Idlewild still super short. So a lot of the mountain areas are super short still. You're going to be able to go ahead and Ukaipa, Redlands, those areas are still way, way down. Loma Linda still way down. You're seeing Colton still way down. You're seeing Chino Hills still way down. You're seeing this whole area right here in Riverside. The actual cities of Riverside are way, way down. You're seeing Corona skyrocket up 71% in inventory is what you're seeing there. You're seeing Menifee up 144% in 925 and 92596 in Winchester up 57%. Temecula up 52%. Awanga's up 67%. Hemet's up 84%. So San Jacinto's up 170%, guys. You're seeing, Banning up 104%. So you're seeing a lot of those areas in Southwest Riverside County starting to tick it up. You're seeing kind of the more expensive areas. Like I said, the affluent areas like Duluth still down in inventory there as well. I mean, you're seeing markets like Paris up 32%. So you guys can kind of see this. You're seeing all these areas continuing to really kind of get Apple Valley up 100% in inventory. Hesperia up 50%. Phelan up huge. So let me go ahead and I'm going to go ahead in the chat real quick and I can look at it. Okay. So let me go through here and I'll start going through the top. I just showed Riverside and San Bernardino County. Okay. So let's go to St. George, Utah. Why I pull that up? Can you guys, what county is St. George in? If you guys could drop that into the chat. I'm going to put Wasatch County. So let's see here. Let's do this. Wasatch County. Let's see if they have these. Some of these marketplaces don't have it, but let's see if I can do Wasatch. Oh, it's Washington County. So let's see. So that one's not in. Let me just go to the state of Utah. So I'll pull this up for us here. Let's go to Utah and I can pull it up this way for us. Boom, here you guys go. All right, so Washington County, which is St. George, Utah, inventory levels are up 87%, guys, 87%. And these links for this data, you got to buy it. So it doesn't mean do any inventory levels to that to be able to send that to you guys. So Washington County is up 87%. Salt Lake City County is up 86%. Provo is up 56%. 67% in the other area of there. You got Heber, Utah, which is obviously, is up there, isn't too far from, is the mountain areas kind of, you're going to be seeing a lot more stuff, a lot lower things, once again, a much more affluent area. Ogden, Utah up 68%. And then Ogden, Utah up 60% there as well for you guys. And let me go to San Diego County for you guys here, and I'll zoom in there. So let's do, and then I'll take one more if you guys want to drop that into the chat before I go over to the other inventory levels. Let's go here in San Diego County. So let's see where we're getting inventory first. We're getting a lot of inventory up coming in Chula Vista. We're getting a lot there. We're getting a lot of inventory in San Diego 92114. A lot more inventory in Spring Valley. Starting to see it once again. El Cajon area is up 53%. You're going to see, let's see, Lakeside. So a lot of East County stuff is really, really up. And then your really coastal markets, like Imperial Beach, down 52% still. You're seeing Point Loma area down. You're seeing coastal lines of La Jolla all down 40%. You're seeing, let's pull this up here. You're starting to see Del Mar way down, Encinitas way down still, Rancho Santa Fe way down. You're starting to see Carlsbad still way down. But this Carlsbad area, I wouldn't really take it. As you can see, it's only 8 houses for sale. So the bigger part of Carlsbad you're going to be seeing is up 20, or down 26%. Oceanside's up 30%. Vista 67%. So a lot of the coastal stuff in San Diego is really starting to pick up a lot of the inventory levels there. 92117 in Claremont. Let's pull this down. 211. Let's see here. Okay, here we go. The Claremont area is down 8% in its inventory level. And then I'll do Santa Clara County for one more, and then we'll move on to the other stuff so we don't run too long. I can get to everything for you guys today. Oops, not Santa Cruz, we want Santa Clara. Let's go. see, let me go up here. It doesn't have Santa Clara as a market, but let me go here. I can go up to California. Boom. So Santa Clara County is way down, still down 32% as well. There for you guys, they're broken that down. So let's go into here and I'll do San Bernardino. Let's go here. I'll do one more market for you guys. I know there's a lot of San Bernardino County people on here as well. Let's go up here. It won't let me go down to Oregon, but let me go into here so I can tell you guys. San Bernardino County as a whole, inventory levels are up 31% as a whole. So you can kind of start to see some of those inventory levels click up. Now, one of the other things I really want to focus in on here for you guys is, let's pull this up. So as we can see, inventory big decreases as we just went over. Then what I want to follow up with you guys here is showing you obviously where people are basically continuing to move to. So in this latest article that just came out this week, basically this shows you guys the major markets, top 20 markets that people are still massively moving to, which are going to continue to support higher house prices in these areas. Number one market, Miami. Miami, we're seeing a net inflow is still increasing because, mind you, a lot of places are seeing decreases as a lot of the migration has already happened. What we're seeing here in these markets, we're still seeing crazy amounts of migration right now, even with the high house prices. Miami, we're basically seeing dramatically up, about 34% increase in the amount of people moving there from 1 year ago. Today, most commonly is moving from New York, even though house prices are up about 17% from 1 year ago. Phoenix, Arizona. Now it's down a little bit, but still pretty close. So what you're seeing here, you're seeing pretty much on par. People are still moving to Phoenix in the droves. Heavy population from Los Angeles. So even though Phoenix is up 25%, we're still seeing a massive, massive, massive amount. And about 37% of all the people that are looking to buy in Phoenix are moving there still from other areas. Tampa, Florida has one of the biggest in the country. That's a market that's going to continue to boom, even though prices are up 27%. Still, 50% of people are searching there are looking to move there from another area. Sacramento started to see some pretty high inventory levels up, but still 43% of people are still going to be moving from San Francisco and Seattle areas as we're continuing to see that move. Vegas, still getting a good amount of people moving there from LA. Lots of people still moving to Florida's just a booming market. Florida market, Cape Coral, Northport, booming market. Dallas, booming market. Houston, booming market. San Antonio, booming market. San Diego, still getting a lot of people from Seattle and Los Angeles. As I said, that's why the inventory levels are still down. Georgia, hotspot. Florida, hotspot. Maine, hotspot. Virginia Beach, we saw that. Salisbury, which is like not too far from the DC area. Nashville still can be a massive hotspot. People moving there in droves from Los Angeles. Spokane, Washington, seeing people from Seattle and LA moving there. Bend, Oregon, from obviously Portland and Seattle moving there. And Bakersfield, people still moving there from Los Angeles, still in droves, up 55%. Now, the areas that we are seeing people leave the most from still right now, no surprise here, people are still fleeing San Francisco, weak ass market. Los Angeles on the inland stuff, moving a lot. Lots of people still moving out of New York, lots of people moving out from DC, but DC, they're just moving to suburbs. As you'll see, only about 16% of people are moving from actually out of the area, out of the conjoining area. Seattle, huge departure. Boston, huge departing. Chicago, still a lot of people moving to Florida. Detroit, a lot of people moving to a lot affordable, more in the Cleveland, Ohio. Denver is still, a lot of people are still fleeing from there. And Portland, a lot of people are still fleeing from there. Those are a lot of your weaker markets still. No surprise here, just on another map. These were the cheaper markets that you were seeing here. Really, Miami, Tampa, Houston, Northport. Boise City is starting to fall down. New York's falling down. Denver's falling down. So you're seeing some of the weaker markets where there's being just tons and tons of people leaving still, as San Jose, LA, Seattle, Washington, and Boston, even still today. Now, what I like to look at are the big price appreciators, even with seeing interest rates rise. These are the markets that over just the last 3 months have continued to see massive appreciation, even in the face of higher interest rates. Look where they're at. Tons of Florida markets. Vegas, we just talked about. North Carolina, more Florida markets. North Carolina, San Diego. Like I said, San Diego and Orange County are going to be a real outlier here in Southern California. Those markets are really insulated. I mean, I've lived in San Diego for a long time. I live, in Temecula area. San Diego area is still a booming market, even more. Look at all these Florida markets, guys. Told you, Florida is going to continue to boom for at least the next year but you also too, about 25% of all the homes that are being purchased in Florida are not being purchased by individuals. These are being purchased by massive hedge funds that are going into D.R. Horton, Lennar, going in and buying entire developments out to turn in for rents. Because as these institutions have continued to see, they're having to buy with very, very low cap rates, meaning let's say it used to be a 5% cap rate. That means the net income from that investment would take 20 years based on its current income to pay for the price. It spent 20 million bucks on something, basically, and it's going to earn $1 million of net cash flow. That's a cap rate of 5%. Cap rates have plummeted in multifamily. Some is down as 2 and 3%. So what you're seeing people do, a lot of large institutions, big hedge funds like Celebration and all these other ones, they're actually going out there and rather than buying multifamily properties, they're buying entire communities of single family homes to turn in for rent because they're able to get a 6 to 9% cap rate, 3 to 4 times the cap rate that they would be getting if they bought a Class A multifamily apartment building. Lots of Nashville, lots of Texas. So you guys can really see, like I told you guys, South Carolina, Florida, North Carolina, Tennessee, Texas, San Diego, Las Vegas. Those are markets that have continued to boom, even in the face of higher interest rates and rising inventory prices. And you're also going to see Riverside County still going up. But you have to understand, even though Riverside County's inventory is going up, we're still very short on inventory. But I'm going to go into the key on pricing right now for you guys. But Riverside County, I think, is going to fall off this list. It's not going to be a loser like last time because people get priced out of San Diego, they get priced out of Orange County, they get priced out of LA. They're still going to funnel into that Riverside County market, really heavily focusing on areas that have very good schools in newer areas, which are going to continue to do well in that marketplace. Now, these are the markets that are really kind of more of your stable markets. These are your markets you're going to see here in a bit that if you're looking for long-term rentals, these are your markets that are going to really continue to be excellent cash flow markets. These are the markets that if I was personally looking at getting a rental property in, a lot of the ones that I really like are on here. Lancaster, it's the Pittsburgh, Pennsylvania area, really good one. Richmond, Virginia, Kentucky, Louisville, Kentucky, anywhere really in Indiana is really staying out. Lots of stuff in Louisiana sticking out. You're getting Hartford, Connecticut. Santa Rosa has very, very low inventory. As people continue to move to that Santa Rosa area from the Bay Area. Maryland, as people get out of the expensive DC area, this is a great rental market. It's actually a market I'm trying to buy about 12 homes right now in that marketplace with a partner of mine there. That's another booming market. You're going to see Northeast just continuing to really, really, really perform. And then obviously your Midwest continuing to perform very well in those rental markets. So what I want to show you guys here, this is something that's really important. These are the markets that it is now with rising interest rates are so expensive to buy a home there that renting completely makes sense. And any one of these really that have a reading over 50%, what that basically means is it's literally 50% or more expensive for what the average rental home is compared to what you would have to pay for that home. So these real markets right here, these kind of 16 markets, these are my kind of like, stay out of those markets with the exception of about 3 of them that I think of, not that you guys, I wouldn't buy a rental home here, but I would still probably invest in here, and I'll let you guys know. San Jose, it's 200% almost more expensive to buy there than it is to rent. San Francisco, 150%. Austin, Texas, Seattle, Salt Lake City, Provo, Portland, Madison, Wisconsin, which is really kind of surprised me, but I'm not really putting it on this list because realistically, it's still a super affordable market. In Madison, Wisconsin, I'm actually going there in a couple of weeks to actually look at a couple of properties because it's actually having a booming finance sector, a booming tech sector, and it's really starting to grow. And you guys can still see the average housing payment is so low, you're going to still continue to see people move into that area that want to deal with that winter. Denver, Colorado, this market, I definitely think it's softening. It's definitely showing signs of softening as people move to adjoining counties. San Diego, I'm not even putting on this market because truthfully, their annual rents can where the housing payment is. What they did is when they compare these as a 2-bedroom, it's nonsense, in the sense of that market is so short on inventory, the weather is so good, and we're still seeing super low inventories. This is a market I would still be buying if I was purchasing my primary home and living there long term, without a doubt. The LA market I would avoid, Ogden I would avoid, Spokane avoid, better to rent, Boise, better to rent, Oxnard, better to rent, Sacramento. This market I'm still kind of on the verge on because it's still seeing a high drove of Bay Area stuff. So I think that's going to be able to continue to do on those markets. So those are really kind of the markets there that I still think is a lot better to rent than it is to buy. Now, what I want to show you guys on this chart, these are the markets right here that are still provide excellent opportunities to purchase either a rental home or an investment home for long-term rents. So all these areas, not only do they have decent schools, the wages really still support the housing. They've not seen the explosion. They're a much more stable market, and they're going to continue to cash flow really well, as you're going to see on this next sheet. Indianapolis, Indiana, Syracuse, New York, anywhere really in Ohio that you're going to really see this. Tampa, Florida, I told you it's still going to be a booming market. A lot of Little Rock, Arkansas, Birmingham, Alabama, Pittsburgh is one of my absolute favorite markets in the country right now for long-term rents and good buys. Anywhere really in New Orleans. Oklahoma City, Oklahoma is really coming to its own as we continue to see OU and OSU obviously really kind of drive and keep a lot of their college students there. They're bringing a lot of youth. The market, Oklahoma City, is a really cool market. It's really kind of becoming almost like a little mini Chattanooga or a little mini Austin out there. It's a really cool market. You're going to see there pretty much anywhere in Ohio, Georgia, Florida, even some areas in North Carolina and South Carolina there, Memphis, Tennessee, Jacksonville, Mississippi. All of those are really good cash flow markets there. And you guys are obviously going to see a lot of those same ones. This basically shows what the value of the home is compared to what somebody earns. Basically the best markets that it's still very affordable for people in those markets, which is going to continue to drive appreciation in those markets. You're going to see a lot of the same ones I just went over there. And these are really where the best cash flowing markets are in the country. What this means is the annual rent compared to the home value, meaning basically it's that 1% rule that people talk about. If you buy a house for $300,000, you'd love to rent it for $3,000 a month. It's kind of gone in most markets with interest rates on investment properties being in the 6% range, but these markets still provide really, really good opportunities, either because they have very low property taxes and or wages are still very, very high compared to the cost of housing. You guys are going to see the same markets continually to show themselves in all of these areas between, kind of the south, southeast markets, as well as some of the Midwest markets really in there. And that's really where we're going to see a lot of those items. Now, I want to kind of go to the macro picture for you guys so I can leave enough time here. So here's my complete thoughts on what's really going to happen. We've seen the stock market take a shit, excuse my French. We've seen inventory rise in a lot of the West Coast markets. We've seen mortgage rates make housing payments about 40 to 50% less affordable or more expensive than they were just a year ago. And we finally started to see inflation just start to tick down. Now, what I see happening is the Fed is going to raise the federal funds rate by 50 basis points and when they meet next month in June. I think they're going to go ahead and raise it by 50 basis points again in July. But then in August, when they meet again, I think they're going to have to say the famous terms, which is basically going to say in the stock market right now has about 150 basis points in rate hikes priced in. What that means is everyone expects we're going to get about 130 to 150 basis points more of rate hikes before the Fed has to kind of pause. But I'm telling you right now, mortgage interest rates, not that they're cheap right now, but they're down about 1/8% over the last week. And they've kind of started to flatten out because as we've kind of seen inflation get under control, a lot of these risky assets, people are fleeing the stock market, going to the safety of bonds, meaning this, hey, I don't want to put my money into Netflix, which is down 80%. I'd rather get paid a 3% bond by the federal government right now. So let me move my money into bonds. And when people leave risky assets and move into safe assets, the interest rate that you have to pay on that debt or those safe assets, you don't have to offer as high of an interest rate because you have more demand flowing into it. And by doing so on that, it ends up bringing down the interest rate that you have to pay somebody, which brings down mortgage interest rates. So I believe in about August or September, the Fed's going to come out and say, hey guys, stock market's way down, and we just saw this happen. And everybody needs to remember, if you guys forget everything I'm going to tell you about this, about the Fed, there's two things the Federal Reserve is required to do. Number one is maintain stable consumer prices, meaning stable prices on food, energy costs, and housing. Second thing they have to do is maintain maximum employment. Well, we saw unemployment rate be down in the low to mid threes. Well, we saw consumer prices shoot through the roof, meaning they're failing at one and succeeding at the other. So what they have to say is hey, we now have to leave our monetary policy of basically giving free money out in very, very low interest rates. We got to raise interest rates, stop all stimulus, cease or really drop down how much mortgages we're buying as a federal government, because unemployment's so low we can do this because we got to get this inflation under control. But what happens is once they basically kill the market and put us into recession into doing so, a recession is defined as 2 quarters of negative growth, meaning if I was a company and I did $1 million in sales in the fourth quarter of 2021, so I did $1 million in sales in the fourth quarter of 2021, and let's say I do, $900,000 in sales in the first quarter of 2022. That means, yeah, I still had sales, but it declined. It was declining rather than increasing. That's negative growth. And that's exactly what we had in the United States economy. We thought we were going to be growing on an annualized rate around 1.5 to 2%. We actually are subtracting at about 1 to 1.5% right now. And that's step number 1 to being named into a recession. The second part of getting named into a recession is you need a second quarter of that. So I'm a firm believer that in the second quarter of this year, when these numbers come out in July or August, it's going to come out that we lost growth again for a second quarter, and we're going to be deemed that we're officially in a recession by late summer. When this happens, we're officially deemed into a recession, what the Fed's going to have to look at is, okay, how are jobs doing? I'm slowly getting down the inflation, but I got to make sure I'm maintaining high employment. Well, what does that look like, right? Because if that looks like it, what they got to do is if employment starts to decrease, meaning we see unemployment tick up, they got to tell themselves, holy crap, we got to stop raising interest rates. We just got to pause. And when they pause, we are going to see mortgage interest rates dip back down. I think we could probably see as much as a 0.5% decrease in mortgage interest rates from where they will peak, from kind of the peak to where they'll at the end of the year. So let's say they peaked around 5.5. I think they could get back down to 4.75, 4.875 in the fourth quarter of this year if we're officially named in a recession and we see jobs actually starting to actually be, lessening, meaning more unemployment. So what does those unemployment numbers look up? So what we can actually go ahead and do is I'll pull this up for you guys. Here, let me go ahead, and we actually saw the unemployment figures actually begin to start to tick up. And I'll show you guys that right here. Give me one sec while I pull this up. And what we're going to basically start to do is we're going to start saying that, here we go, one more. Okay, here we go. Okay, so basically what's starting to happen is we are seeing the unemployment begin to start to tick up. So the unemployment rate is actually starting, the revisions are higher. We're having more, we had 47,000 more people in California file for unemployment benefits in the month of April than they did in the month of March. So what we're seeing and we're starting to see these revisions upward. So we've seen massive layoffs in a lot of the tech sector. So we're starting to already see those unemployment numbers just tick up slightly. We're still very low. Unemployment rate's 3.6 from the low. I think we hit at 3.3. But if this number starts to really get into the 4s, we're going to really have to see the Fed pause. And so kind of as a summary before, and drop your guys' questions into the Q&A, and I'll take some Q&A for about 5 minutes. But one of the things I want you guys to understand is the markets and the housing markets in general are going to really start to participate very differently. For example, on my screen on here, and a really cool trick that everybody can utilize to see how a market's behaving, because a pricing strategy, like I told you guys would go about, is right now, let's say you have a comp, and let's say your comp is a model match, and let's say that comp sold in March, and that comp sold for $600,000. If I was a listing agent, I would price that home at $550,000 today. Even though, because the appraisal is going to use comps that closed from several months ago, so you're going to get a high appraisal, which is going to leave the buyer feeling that they're getting a good deal on the home, and you're going to be priced aggressively in the market. You have to do that, because watch what's happening to people that don't do that. So here in Corona, I go to redfin.com. And what I like to do is I'm searching for just single family homes, and I'm searching for just homes that are active, not coming soon, not pending and under contract. And I do that. Now, that gives me 294 houses that are currently listed for sale in the city of Corona right now. Then what I go ahead and do is I come down here and I apply my filters and I say, I want to know how many people have had the price reduced in the last 30 days. Okay. So the last 30 days, out of the total 294 houses, we saw 65 of them have price reductions. Now, mind you, this time last year, we had about 10% of all homes have price reductions. So we got a total of 65 homes that have price reductions out of 295 homes. So what is that percentage? 65 divided by 294, 23%. So we had less than 10% that had price drops a year ago. We're double, a little over double the amount of homes that are having price drops. But watch what happens. Now, once that price drop occurs, okay, how many of those homes are still left on the market after 60 days after that price drop? So if I drop the price of my home, how quickly is it then selling? And check this out. Of those houses that are getting price dropped, we only left with 3 homes that are left on the market after a price drop right now, after 60 days. So only 3 houses out of those 294. So only 1% of the houses that are listed for sale are still on the market after having a price drop after 60 days. So the key is right now when you're structuring your offers with your clients, that's where you really want to break it down and show people on how to do that. So I'll go ahead. If you guys want to drop any of your guys' questions in those comment sections. So let me go ahead in the Q&A and I'll take a couple of them. Okay. Wendy Whitelaw, how do these inventory numbers count against 2009 inventory numbers? So what they've been measuring is we go 2 years back. So give you an idea here in Riverside County, Wendy, we are still down on our inventory levels 50% from where we were in 2020. So still down 50%. So pretty much most markets are still down from where they were in 2020, except for a couple outliers like Boise, Idaho has a significant amount. Provo, Utah is still above, is actually above those 2020 numbers. So David Spears, what do you suggest someone to do with $350,000 equity in their primary home? Situation being the home is maxed out of value-wise in the neighborhood, looking to turn $350,000 into $700,000. So one of the things I would do first and foremost, don't touch your first mortgage rate at all. Leave your first mortgage rate alone. What I would do is pull equity out of my home using a home equity line of credit, utilizing AVEN. If you're in California, that's AVEN.com. Go to there, see if you can get approved without an appraisal and get yourself a home equity line of credit. I would immediately draw on that home equity line of credit because it's very well known that when we start to go into recession, banks will freeze the lines of credit that are open to not allow any draws. I would then take that money and I would sit it on the sidelines and I'd watch the market to what happens over the next about 60 to 120 days. Then what I would look at is I would look at putting that money into an Airbnb property or a long-term rental cash flow property. An Airbnb property that's going to be a great property is going to be located in an area that's roughly about 4 to 5 hours outside of a metro area, no greater than that. And it's in an area where what people go there for isn't really expensive. For an example, going to the mountains, going to the beach, those are free activities to be able to do, going to a lake, going to a city and see the sights, going somewhere that isn't going to be like going to Orlando. Orlando's going to see a little bit of a dip. People in a recession aren't going to be going and spending a ton of money at Disney World. People aren't going to be spending a ton of money in Nashville. They're not, not Nashville, in Anaheim going to Disneyland. They're not going to be flying all the way to Hawaii. They're not going to be going and doing things that are very expensive. So I'd put it into that area. And if you actually, hit me up, I can get you pre-approved. We can look at that and I can do it more. Or I'd look into some long-term rental markets if you don't want to deal with Airbnbs, looking at some cash flow markets in the Midwest. So let's see here. And okay, in the Southern California markets, primarily Riverside County, what is the best way to respond to educate clients that believe that the home prices will drop and they're waiting for a bubble to pop before they buy? So truly, here's the honest answer. So my firm belief that if somebody buys a home today and they want to sell that house in 6 months, I think they're going to get a better deal on a house in 6 months. I really do. I wouldn't lie on that factor. However, if somebody's going to be buying a home today and because the rent's coming up or they have some event that is going to be coming up and they really want to buy within the next 60 days, what you can obviously let them know is, number one, our inventory levels are down still 50% since 2020. Number two, that you're going to want to let them know is mortgage interest rates will be at least 1% lower in a year. So if they can afford to purchase that house today, they're going to get multiple opportunities to drop that housing payment over the next couple of years. So what I would do is say, okay, if I know that the rent of a 4-bedroom house is $3,300 a month, if I can get one here in, let's say, Temecula, California, on a 4-bedroom, it's $3,300 a month, probably more like $3,600 a month. And buying that house with 5% down is $4,300 a month. But I know within a year and a half from now that $4,300 a month, I can refinance it down by 1.5%. And that puts your mortgage payment at $3,400 a month. Well, your rents are going to continue to go up. Rents are not slowing down in any way, shape, or form. As more people want to continue rent, now your rent's at $3,800 a month. So now you're in a position where you're actually going to be better off owning than you are renting that property. Now, if you're the type of person you're living with mom and dad, then honestly, don't try to sell them into something that's, not true. And if they could stay with mom and dad for another 6 months, I know everybody wants to make commission checks, but we're going to gain a lot of raving fans on being honest. And so, hey, you know what? I know that once we actually officially go into a recession, we get a little bit more inventory, there's gonna be some great buying opportunities in the next 3 to 6 months. See if you can move in with your dad. Rates are gonna drop. Inventory levels we're not gonna see a housing bubble. When we saw the peak of the 2000s, there's not even possibly enough houses that would come to the market that put us anywhere near close. We had over 3 million houses that were listed for sale in 2007. It's about 5 times what we have today. We also have a population of millennial buyers that's 72 million strong, the largest generation of all times. And those people are going to continue to support the market. I think Riverside County, if I was going to say a worst case scenario from where we're at right now, I think probably a 10 to 12% decline in home prices over the next 2 years as a worst case scenario.